You can't open a browser or turn on the news without hearing about AI. I mean, it's everywhere. It's promising to completely reshape our world and, well, the market is betting trillions of dollars that it will. But does all this hype feel a little familiar? Today, we're going to try and answer the one question that seems to be on everyone's mind. Are we watching a real technological revolution unfold, or are we just riding history's greatest bubble?
Okay, so let's get right into it. This AI explosion we're living through, is it just a replay of the dot-com bubble from the late 90s? To even begin to answer that, we really need to take a step back and remember what actually went down back then.
You know that old saying, history doesn't repeat itself, but it often rhymes? Well, the dot-com era is pretty much the perfect blueprint for understanding how a tech bubble works, how it inflates, and more importantly, how it bursts. And it all happened so fast. In 1995, the internet basically went mainstream and captured everyone's imagination. By 1999, it was pure madness. Speculation was out of control. Money was just pouring into any company that had a .com at the end of its name. And then, just as quickly as it started, it all came crashing down. And this right here, this is the most important part to understand. The promise? The promise was 100% right. The internet did change everything. But the fatal flaw wasn't the technology itself. It was the business models, or, the lack of them. You had companies like Pets.com that were built on nothing but hype, with absolutely no clear path to ever making a profit. So what was the trigger? What popped the bubble? Well, the party came to a screeching halt when the Federal Reserve started raising interest rates. All of that easy, cheap money that was funding all this crazy speculation, it just dried up, and the whole house of cards came tumbling down. Okay, so let's fast forward to today. Because when you look at the AI boom, you see something that looks totally different on the surface. It's what I'm calling the paradox of profit. And I mean, the difference is just night and day. Back then, it was all about these speculative startups with zero revenue. Today, the companies leading the AI charge, we're talking Microsoft, Google, NVIDIA, they are literally some of the most profitable corporations in the history of the world. They're funding this revolution with their own enormous piles of cash. So it's all good, right? Solid companies, real profits. What's the problem? Well, not so fast. The whole "this time is different" argument, it kind of misses a new, much sneakier danger that's hiding right out in the open. See, the real risk this time around isn't about hype versus actual profit. Nope. It's about an absolutely unprecedented concentration of power and value in just a tiny handful of companies. Just look at this number for a second. 80%. Let that sink in. What in the world could that possibly represent? Well, it represents the slice of the S&P 500's entire growth that comes from just 7 companies. The Magnificent Seven, as they're called. That's an insane level of concentration, and it's all fueled by their huge advantages in things like data and network effects. The more people use their stuff, the smarter their AI gets, which just creates this flywheel that's nearly impossible for anyone else to compete with. You can really see just how lopsided this is. The gains aren't spread out through the economy. It's more like a tiny sliver of the market is holding up almost all of the weight. That is a very different kind of risk than what we saw in the dot-com era, which was spread across thousands of tiny, unprofitable companies. This is a great way to think about it. Imagine the entire market is this huge, complex structure, but it's balanced on just a few critical support beams. If just one of those beams, say a single, crucial chip maker, starts to wobble, the entire thing could collapse. And here's the thing. Those support beams are already showing signs of strain. We are dealing with a very real input crisis. There's a global shortage of GPUs. Those are the specialized chips that do all the heavy lifting for AI. And the amount of electricity needed to power these giant data centers is just crippling. The whole system is basically running at its absolute limit. So if the whole structure is this fragile, how could it actually break? Let's walk through 3 ways this whole thing could potentially unravel. First up, the regulatory squeeze. Imagine governments, worried about monopolies and data privacy, suddenly get serious about cracking down. New rules could stall innovation almost overnight. Second path, the plateau of profit. The market is expecting some world-changing killer app to justify these crazy high valuations. But what if it just never shows up and revenue growth starts to slow down? And third, an old enemy comes back to haunt us, an interest rate shock. If inflation spikes and the Fed is forced to raise rates again, just like they did in 2000, today's sky-high stock prices could start to look totally nuts. So after all that, where does that leave us? Are we standing on the edge of a genuine revolution, or are we just ignoring a massive risk staring us right in the face? Here's the bottom line. Unlike the dot-com bubble, this AI technology is the real deal, and the companies leading the way are making unbelievable amounts of money. The problem isn't the tech. The problem is that the entire market's foundation is resting on this dangerously narrow base. There's no doubt about it, the AI revolution is here. It is going to change our world. The real question we have to leave you with is this. Is the financial market that's supposed to be supporting this revolution built like a fortress, or is it just an incredibly elaborate and very fragile house of cards?